Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the Marketsite in Times Square, Danielle Shay is back with us. She's the Director of Options over at Simpler Trading, and we're going to do a run-through of learning how to hedge using the options market. Danielle, it's great to have you back with us. As always, before we get into your charts, has been an interesting week with earnings for sure. A couple of patterns are emerging here.
Yes, it's been really interesting, especially because of the pattern going up into this earnings season. So we've already seen some of these high momentum stocks losing their momentum, and even more so going into the reports, they've just been very, very soft. So I'm concerned here that if we see some bad reports, that the bottom is kind of going to fall out of the market.
And we have certainly seen that with a number of individual names, but let's pull up your first chart here. This is the Nasdaq 100, our proprietary index here at Nasdaq, and you're taking a look at the behavior since you were here last time.
Yes. Yes, so one of my favorite options trades that I like to do is trade the run up into earnings, but I like to caution what happens the week after major tech earnings, because oftentimes we see that positive momentum and excitement, but then once that excitement kind of runs out of the market, these are the areas in here that you've seen over the course of the last 4 quarters of earnings reports, what happens in the next 2 to 3 weeks after big tech earnings.
Right, so we had a very busy week of Nasdaq 100 companies. We had Microsoft last night, we have Amazon tonight. For those of you listening to the replay, which is today, October 24th, so this is the week that we're talking about, but still the lesson here applies. So either next week or the week after, that's when you're going to look for a little bit of selling pressure on the index.
Yes, that's correct, because the excitement is over, and at that point, the index typically tends to pull back a little bit.
Okay, let's take a look at your next chart. We have Nasdaq 100 targets. These are the levels you're going to be watching.
Yes, that's correct. So whenever I'm looking for a pullback in the market, I typically like to look for areas of support. I like to look for key moving averages. The first one that I've outlined, this yellow one right here, that's going to be the 50-period simple. That's pretty typical pullback zone that I like to look for. And then I also like to look for the 200-period simple. Those also overlap with key psychological values, so the index tends to pull back around those areas. So the first pullback zone that I would look for would be 7,800, and then beyond that, if the market didn't hold support, then I would look for the lower level, lower at 7,500.
Okay, well, the obvious question is, if I have a long portfolio, what can I do to hedge myself if I think this is what the price action is going to be like? On your next chart here, you have the cues and you're looking at a specific setup here. Tell us what this is.
So it really depends what type of size account you have. For me, I like to trade the cues when I'm hedging because it's a cheaper product. I like to trade multi-leg options spreads, and so it has enough volume, it has enough open interest, and you have a lot of different strikes that you can work with. So what I like to do is I like to place butterflies to the downside, and I like to use the center strike of my butterfly at a key area of support that will allow the price action to fall down into that area of support, capitalize on the long put on the butterfly. You also make money on your short puts as long as price action stays above your short puts. And for me, that's a great way to hedge. You can also use additional Nasdaq products as well, but I really like using the cues.
So let's talk about the P&L here. What does this look like? What are you getting in at? What's your target?
So this trade right here, this is a $10 wide butterfly. So when you're trading a butterfly, your maximum profit potential is going to be $10. On this example, you're paying $1.87. So for example, you pay $1.87, you're never going to get your max profit, right? So if you target even a double or a triple, I think is great. But in a perfect world, the cues would pull back to 183 around the time of expiration, which in this example is going to be November 15th. And then you would be able to get around $8 or $9 on the trade. So after you subtract your costs, have about $9 subtracting your cost, and there's your profit.
I mean, that's not that bad for a hedge because you have the power of leverage with options. Can you use a butterfly strategy for any other thing besides earnings? I mean, is it something that you trade regularly exclusive of the earnings calendar?
Oh yes, I use butterflies all the time, and especially for this example, we have a lot of members who have smaller accounts, and $1.89, that's $1.87 is $187 per contract. So especially if you have a smaller account, that makes that trade available to you. You can also trade, of course, NDX, the higher notional value, and I love trading butterflies really on everything. I trade for earnings, pre-earnings, post-earnings, momentum setups, and especially for hedging because it can be so cheap.
Is it also used as an income strategy?
Yes.
Really big, yeah.
Yes, you can definitely use it for an income strategy as well. I primarily trade a little bit more directionally, so I like to try to capitalize on directional moves in the marketplace. And so because I use a lot of Fibonacci and technical levels, I place the butterflies around those levels because I already have my price target, I already have an idea of where it's going to go. And so the reason why the butterfly is so much better than just using a long call or a long put is because you're bringing your cost basis down, 3 or 4 times. And also this type of option strategy allows you to sit through volatility over a span of time. Whereas with a long call or put, it can be a little bit crazy for some traders.
Yeah.
So
At least your risk is defined here.
your risk is defined. Yes, exactly. Your risk is defined.
Yep. And another thing I like about your trading strategy, you seem to stick with the stocks that you know well, fundamentally,
Yes.
and also how they act on the charts. I remember you speaking about that at a conference, and people have very different styles. Some people trade momentum, they trade news, but I think it's interesting, you have your basket of stocks that you trade well with.
Yes.
And you don't necessarily always have to capture what's happening in the news.
Yes, exactly. I trade actually Amazon all the time, and I use Amazon with butterflies, particularly because Amazon has a lot of high open interest in particular strikes. So, 1850 or 1800.
Amazon reports tonight, because again, it's October 24th for those
Yes.
of you on the replay. Do you have a position on going into earnings?
So what I'm going to do with Amazon is trading around $17.75 right now. It usually has an expected move around $100. And so what I like to do is go slightly underneath the expected move, so about $75 or so, and then I like to pick a high open interest strike. So I was looking at a potential of trading it up to $18.50 and placing a bullish butterfly around that strike price with my short strike at the center strike for a bullish, cheap earnings lotto trade on Amazon. So I didn't put it on yet, but I was planning on doing that right after this.
Well, but that's easier to swallow. You can handle, a $183 contract versus a $7,500 move in the stock. Thank you so much, as always, for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.